How's it going, guys? Welcome to another bootcamp video. In today's video, we're going to be talking about probably the most important topic, or whatever you want to call it, in trading, and that is liquidity. Liquidity is what drives the markets. It is what tells us whether on the day we're going to probably be looking for shorts or for longs, or if we're not going to trade at all. Now, I do apologize in advance for my voice, and I sound congested. I know I kind of got sick. I feel fine, but if there's some cuts in the video because I have to cough and stuff, that's probably why. So without further ado, let's get started. Like I said, liquidity is what drives the markets in, whatever direction that it does go. So first of all, what even is liquidity? Let's define it. Liquidity is, now this is probably going to make sense, but it's resting orders above highs and below lows. What kind of orders are we talking about? Limit orders, okay? If you don't know what a limit order is, a limit order right here is essentially, I'm going to teach you guys something else, the difference between a market and a limit order. Most of you probably already know this, but if you don't, listen up. A market order is simply when you execute, like whenever you take a market order, you are being filled at whatever level price is currently at. So if I press sell right now with my market order, it would fill me at this price. And we can see here that with the way this candle is moving, this red line is our fill right here. This red line, so wherever this candle moves, this red line follows it to where it fills. And it's obviously going to be like a little bit offset just because of spread and stuff like that. But essentially, I could sell, it would fill me right here. And with a limit order is essentially the same thing. It's an order, but I place it at whatever level that I want it to get filled at, meaning price has to travel to that level in order for me to get in the trade. So if I placed a sell limit, say right here, that means I can place it right here, just for an example. If I put a sell limit here, we can see it's active. So price needs to trade up here and touch 29,700.50 in order for me to get in the trade. So it's basically, it's like the same as a market order, except I want to be in the trade when price is here. Or same thing for a buy limit. If I put it here, that means I want to see price travel here, down here, touch 29617.50, go down, touch that zone, or even if it goes past it, it still puts me in the trade. It's just a matter of traveling to that level. And then once it does that, it puts me in a long position. And like I said, same thing for the short position. If I had a sell limit order right here, price is going to go travel, hit my sell limit, and then I'm going to try to hit the trade, whatever I am looking to make. So now that we know what these orders are, we can explain liquidity. So when I say resting orders above highs and below lows, so listen to me, guys. I'm going to try to explain this as simple as possible because liquidity was one of the hardest concepts for me to understand. For some fucking reason, I had to watch like 9 different videos on it. I was staring at the charts. For some reason, I just couldn't get it. It just couldn't make sense to me. I couldn't look for it on the charts, and I did not know what I was looking for. So I'm explaining this as simple as possible. So resting orders is what we just explained, meaning if it's resting, that means it's just sitting and it's yet to be filled. This is a resting order, meaning it has not been filled yet. Same thing for a buy limit. This is a buy limit. This is a resting order because it has not been filled. It is not actively in the markets. And the way the market moves is by buys and sell orders. So the only way we can move the market in certain directions is by getting these orders filled, which is why you hear the famous order filled. So how do we know where these orders are, and how do we know if they're going to affect the market if price goes to that level? So what you guys have to understand, and you guys probably already know this, as retail traders, we are trading against institutional traders who are managing millions and possibly even billions of dollars worth of assets. And those not even assets, that money that they are managing and putting in and out of the markets is what's driving price in a certain direction. Why? Because it's such a big amount of money that it legitimately affects the stock market. It legitimately moves it. When people buy shares of stocks, people buy this, people buy that. That is what moves it, which is why you see when you buy a stock with a big enough amount of money, that stock is going to go up, or when you sell a stock, it's going to go down. So the reason why it's important that we look at both sides of this, meaning the buys and the sells, because otherwise, if it was always to go up, then everyone would simply just buy, the S&P or the NASDAQ, and it would continuously go up. But the whole reason we have these orders, and the whole reason why it moves the market, is because of premiums and discounts. So the way that we know if price is in a premium or in a discount or could be trading to it is by using the Fibonacci tool, or you can simply just use the box with the line in the middle, because that is the 50% percent level, like 50% plus 50% equals 100%, relatively simple. For the Fibonacci tool, you're going to find it. It's going to be, where is it? Right here, the Fib retracement tool. So you can click it. You can expand it. Now, I know your tool is going to look absolutely different from mine. It's okay. These are my settings. Go ahead, pause the video, and copy these. So these are the only important ranges that you might need, as well as you can add 0.79 as well. But I don't typically use it. So let me explain discount really quickly. Essentially, discount is when we are in a bullish uptrend in price and we get a retrace into 50% of that range because there's a lot of orders there. Why? Because we are getting price cheaper. It's like if you wanted to buy something at a certain price and the store has it at a discount during a certain time of the year. During that certain time of the year, that store is probably going to get more sales of that product while it's in a discount rather than when it's not. So price has to go down into that discount to be able to get more, like for more people to buy it. And then once more people buy it, meaning the demand goes up, means the price of it goes up as well. And the same thing applies to trading. And we can see this really well on a bigger time frame. So here's a perfect example to show you guys what it means for price to go into a discount. Here at 2 a.m., we start this bullish range, right? This is a range, meaning from a low to a high. We have this range here, right? And if we want to keep expanding and keep taking out these draws on liquidity, which don't worry about not understanding that yet, you'll get it in a second. In order for us to expect price to push up like it did here, we would probably expect price to push down into a discount, especially if we're looking to target, price. If we're expecting price to push even higher. For smaller points, it's not going to be useful as much, but we usually see this on the higher time frame. So the thing that we can do here is we can see if I want to long this, I want price to go down into a discount, meaning a lot of people, there's probably going to be a lot of orders there because I get to buy a share of this at a discount and make some money. So we can take our tool. You always want to put the tool, you want to start at the low and put it at the high, right? The 1 at the low, the 0 at the high, or it might be inverse for you. That is how we detect. It has to be the 50% level of the range, or if you're just going to use the box instead, you can do that. Make sure you say, you take the low all the way to the high of the range. And we can see here, price expanded, then it slowed down a little bit, it started going down, and then it started chopping around that 50% range, meaning it's like hesitating if it wants to push lower, push above, and eventually it expands back up. Why? Because we expanded, we accumulated at the 50% range, we got our orders, we waited, took a little bit of time, but it's normal. Boom, we accumulated, then we further expanded up to continue our move. And we can see this even on the smaller time frame. We can see here at the beginning of this move, we have the low and the high on the 1 minute. What did price do? There's a low, high, went up, price came down, traded into that 50% range, and continued up. And we can see this on any time frame and pretty much any time of the day that price wants to expand, retrace, move up in a certain direction. We're going to want to look for price to be in a premium or a discount. And now I'm going to teach you guys what a premium is. So a perfect example of a premium is yesterday's Asia session. We can see we have a range here from a high all the way down to a low. And in order for us to want to keep expanding downwards like we did here, this entire point, we would expect price to go down into go up into a premium, go up into that 50% range. And it's essentially the same concept as when I was explaining buying that product for a discount, except we're doing the same. If you want to sell something, you're probably going to want to sell something when the market of your product, that price of that thing is at a premium. You can sell it for more than what you'd buy. So it's the same concept in the trading market or just in the stock market. Price had a really big expansion down. So in order for, we had all these orders coming down, and in order for us to want to push down even lower, we're probably going to need more orders. So in order to do that, we want to look at the premium level. So like I said, we take our tool at the high, at the low, up to the 50% range. We trade into it, we accumulate a little more, and then we finally expand down. So that is a premium and a discount. Now on to actual draws in liquidity. So as I previously mentioned, draws in liquidity are resting orders above highs and below lows. And you can see I have this low marked out right here, and I have this high. And you guys can probably notice something immediately. Price came out, took this low out, reversed, took this high out, reversed. That is a very, very, very clean example of liquidity that we can see. And I'm really glad that this happened yesterday so I can make this video for you guys. So just as the same concept as we explained for price being in a premium or a discount, we also have draws in liquidity, meaning that price has to go down take that liquidity, meaning when you hear people say, you know, liquidity sweep, meaning price came down, swept those orders, and is most likely going to reverse. So when you hear liquidity sweep, grabbing liquidity, all that stuff essentially just means price push past that level or that low or that high where all these orders are. So perfect example we can see here. We continued our downtrend, but after we continued our downtrend, price wanted to reverse, and the only way it could have reversed is if we took this low. And when I say only way it could have reversed, take that with a grain of salt, because we're talking systematically here. Price definitely didn't have any obligation to go down. It could have, you know, stopped here and reversed here, gone taken out that high, and eventually came back and take out this low, but it didn't. It followed this system pretty cleanly. So we can see this candle right here, the 1:55 a.m. candle. Don't worry about the time frame I'm saying, it's just for an example. We can see here it came out, it took this liquidity, and what did it do right when it did that? Give it a few more minutes, give it like 15 minutes, it started reversing. And where did it target? The other high, the other draw in liquidity. And the reason why I'm explaining this to you is that this is how we know when we want to take a long position or a short position, or when we're determining our bias for the day. So it's like if I'm trading at 2 a.m. for whatever reason, I don't do that. I wouldn't recommend it. At least 2 a.m. Eastern time. The only reason why people would look to long in this scenario is because we took this draw out. If we didn't take this draw out, that means there's still a bunch of orders here, and price probably hasn't gone down to a level where there's a bunch of orders that can drive the market in the opposite direction, so you wouldn't take a trade there, which is also the same reason why we take trades to other draws in liquidity, because once we, it's essentially, you could be like, oh, well, why don't I just get in a long position, just hold that forever? Isn't that technically, you know, how trading works? Yes, but then price is probably going to go to a level and reverse and come back down to your stop loss at some point, which is why we emphasize trading towards draws in liquidity and trading with take profit orders at that draw. So perfect example, like I said, we can see here, price came, swept this liquidity, we got all these orders. Now we have the power, we have enough orders and that are able to reverse price action. And where would we want to target after we have all these orders? Probably another level where there's a shit ton of orders. And when you have a really nice high and a really nice low like that, those are really good key levels that we can go to target. So keeping this as simple as possible, price came down, swept these lows, liquidity sweep, came out, reversed, had this high right here, liquidity sweep, traded past it, boom, and then reversed. But because this was our drop, because of time frames, and because, like, Oliver, how come price today during New York session didn't come and take this low? Because it's a new session, new day, we're gonna have new objectives. Listen to the examples, and everything is going to make more sense in a couple videos when we put it all together. Like I said, guys, it's just insanely crucial that you just take these concepts and you put it into your brain and you understand it, and you take what I say and you don't overcomplicate it. Now, some of you may be wondering, hey, Oliver, but what if price, like, you know, takes the low, but then it keeps moving down and then it doesn't reverse for another day or two? That's possible, which is why we have time-based trading, which is why we trade based off of, you know, sessions. If you're taking trades at, you know, 6 a.m. on NASDAQ or at like midnight or 2 a.m., it's probably going to be a lot more probability, because, well, it's, you know, it's butt-fuck time in a lot of parts of the world, and especially when we have market opens. This is why we trade market opens, because there's volatility. So when 9:30 opens, the reason why the candle is so big and has big movements is because there's all those people that have orders on the New York Stock Exchange, those orders get filled at 9:30, which is why there's such a big move. So at 9:30 is typically when we're going to see a liquidity sweep and a reversal, or possibly an expansion retracement expansion, but that's a video for another day. So like I said, keep it as simple as fucking possible. Another perfect example here, we can see we have New York session open at 9:30. What do we do at 9:30? There's a high here. 9:30 accumulates. We see 9:30 takes this drawing liquidity out, takes this high. Now you may be wondering, Oliver, how come we didn't go take this high, but we still reversed? Why? Because there was a zone of resistance here. I forgot what it was. I'm not going to go mark it out, but don't worry about it right now. Just take what I'm saying at face value. Price goes, it takes a high, it sweeps high, it traded past that level, and then we can see it started reversing immediately, which could help us determine our short bias. Okay, we took this draw, a lot of orders, so we're probably going to look to reverse now. And we can see price came down, targeted this low right here. So we took this low, and then we started chopping eventually, but because it's time-based manipulation, time-based taking orders and stuff like that, because, you know, the volatility starts to die down in the afternoon, which is why not many big moves happen. Like I said, a lot of stuff that I'm saying doesn't have to make sense right now, which is why I'm just saying take what I'm saying at face value and understand that liquidity sweeps is just what moves the market. We took a high, we reverse. Okay, we can take a low. Another good example here. Perfect example of it taking a long time. Here we see We accumulate 930 opens. We have a low and we have a high of a range. Now you're really like, well, how do I know which highs and which lows to, mark out or for price to target? Perfect question. Session highs, session lows, and higher time frame highs and higher time frame lows. Example, because price loves to go target, those session highs, there's a lot of orders at that high. So we have like Asia session high and Asia session low, London session high, London session low, and we can even scale up. We can even scale to a different time frame, and we can see, where are my boxes? Okay, and we can see that we have a high right here. Remember what the high was? A up candle followed by a down candle. We have a down candle followed by an up candle. So these are higher time frame highs. They're usually gonna have a lot more power, a lot more orders above them compared to like a random 1 minute high or whatever, whatever like that. So great example we can see here. We open, market open, bunch of orders came flooding through. What do? Immediately sell off. Huge sell off that we had. We came out, took this key level, right? So after we take this key level, we're probably going to be looking for longs. And we can see, boom, we take out the key level and eventually we reverse. Now, how come we didn't go back and trade back to the high? Sometimes it's not always going to play out immediately, right? We can see, and I probably would have targeted this high as well just because it's the 930 high and there's probably a lot of orders here as well. So anyways, we can see that we accumulated, we took out this low, and now we can look for buy orders. And even if you had taken a trade here, you took this, whatever trade you may have taken, it probably would have played out relatively well, and you could have taken partials, and you could have taken some profits and dragged your stop loss and made money on the day. But what can we notice? We can scale up to another time frame, the 15-minute time frame. We can notice that we had this low right here, manipulated it, and after we made that low for the reversal, what did we do? Eventually, we took out this high. And then what did we do after we took this high out? We accumulated a little more, took out an extra high, and came back down. It's literally what trading is. Trading is legitimately a game of price going up and down and going through ranges, going through and you being able to analyze where it could go. And liquidity is the most simple and obvious confluence that we can use, that we can see every single day that moves price. Matter of fact, not even every single day, like literally 24/7, price is constantly looking to go attack highs, attack lows, and just be able to reverse and eventually push price in whatever direction that it wants to go. So that is legitimately it for liquidity. That is it for this video. You guys need to dumb it down as simple as possible. It's simply just resting orders above highs and below lows that drive the market. Matter of fact, I'll write it back down for you. Liquidity, it is resting orders above highs and below lows. And there are other key levels as well that we can use to identify where the price is going to go. But for right now, I just want you guys to understand the concept of liquidity. So listen, you guys just have to push through this. I know it can be confusing. Rewatch this video if you have to, but I promise you, there will be a point in the series where everything is going to start to click, it's going to make sense, and you're going to be able to take trades on your own. For now, just take my advice as I'm saying this, as I had to learn liquidity by watching 10 videos on it. Just take my advice and listen to what I'm saying at face value. And matter of fact, you can even go on the market and start spotting out liquidity. I want you, that's your homework for today. Go on the market, mark out highs, mark out lows, and see when they get taken out and see what price does. If it doesn't, if price takes out a high or a low and you're like, okay, well, it took this high, but it didn't reverse, don't even worry about it. I want you to just get familiar with it. I want you to get familiar with being able to spot highs and lows, draws in liquidity that get taken, and price reverses. If you see price took out a high or a low, don't sit there for half hour trying to give yourself a reason why price didn't reverse, okay? We can't control price as traders. We can't control price as retail traders. Sorry. The only thing that we can do is react off of what the market does and what it presents in our faces. We cannot move the market. We need to stop acting like we can move the market like a lot of traders do. They think they marry their bias, they marry their trade setup, they marry this, they get frustrated when it doesn't work. Listen, guys, we can't move the markets. We can only react off of what it's doing. All right? That is the end of this video. If you have any comments, make sure to leave them down below. I'll be super happy to help you guys. If you want to join the free Discord, send me a DM. Any questions, please do that. I'm here to help you guys, giving all this game out for free so you guys understand this and eventually get good at trading. So without further ado, that's the end of this video, and I will see you guys in the next one. Peace.